Good morning, everybody, and thank you for joining me for an introduction to pre-year end planning. The purpose of today's webinar is to highlight why it's important for a business to carry out a review ahead of the financial year ending. And then a bit later on, we'll have a look at some ways of mitigating corporation tax liabilities. So why is pre-year end planning important? If your planning consists of discussing your year-end accounts with your accountant once that your accounts are prepared and you've got them in front of you and you're reviewing what's happened in your year, it's too late. You're not planning, you're just reacting to what's happened. So we like to meet clients 4 to 10 weeks before a financial year end, and using interim figures, we project the likely profits for the year and the associated corporation tax liability thereon. So that allows us to project personal tax bills too, because we can measure salary and calculate what dividends we can put through. So it's all about planning. Corporation tax liability is not due until 9 months after the year end. So the first benefit of a pre-year end meeting is to give you plenty of advance warning of your expected tax liability. It's better to know 9-10 months before you're going to have to pay out a chunk than a week before, 2 weeks before. You really can't plan, and if you don't have the money, it's difficult. So we like to give you enough notice. Another reason is that some planning opportunities can be missed if they're not discussed within the year. In short, you can do more pre-year end than post-year end. There's some methods that you can't do after date, which we'll move on to. Setting a timetable helps you to ensure that your year end runs smoothly. It may be that funders need financial information by a specific date, tenders requesting accurate information, or it might even just be to improve your credit rating. There's several common ways of mitigating tax liabilities, which we'll come on to shortly. But as I mentioned earlier, some need to be implemented ahead of the year end. Reviewing the timing of dividends can help to make the best use of available tax bands and allowances, and it ensures that further taxes such as the high income child benefit charge can be avoided if possible, of course. And finally, reviewing the performance based on previous years helps us to identify areas of your business that aren't being fully exploited or aren't performing particularly well. So it helps you drive your business forward as well. So corporation tax, we'll look at the planning for corporation tax first. As you can see there, profit declared in the financial accounts will be liable to corporation tax, currently at a rate of 19%, payable 9 months after the year end. Now, the corporation tax rates are actually rising from 19 to 25% with effect from the 1st of April next year, which will make planning even more important, though it's not as bad as it sounds, because the 19% will still apply to companies with profits less than 50,000, so your smaller companies. And then there'll be a marginal rate for profits up to 250, which we've had in the past, so some of you might remember. The first step is to estimate what your liability might be. So this can be done by taking your current management accounts, which might cover 9 or 10 months to date, and then projecting the likely level of profit for the whole year. The easiest way to do this is to simply extrapolate the management accounts, but this may, of course, not be too accurate if your business is seasonal, so you might have to take that into account as well. Once you've got your expected profit, if we multiply that by 19%, that will provide you with an indication of the likely level of tax that you'll be needing to pay. So we'll consider some of the options now that help you mitigate some of that tax. If you've previously made losses which haven't been utilised, so you've had set-up costs the year before, or you had the pandemic's a great example. The pandemic's suppressed your profits last year. You may have losses that you can use to reduce your current year's profits and therefore reduce your tax liability. So that's something to take into account. Conversely, if you've had a bumper year because of the pandemic, or you've just found a new market, or profits are soaring, if your taxable profits exceed 1.5 million, you need to make payments on account quarterly. So your first year, you're fine. Your second year, you need to make quarterly payments so that by the time your year ends, you've just got one corporation tax payment to make. So it's important that you know what your liability is so that you can make accurate payments on account and you don't get charged the interest. Just a quick warning, there's still plenty of, shall we say, shady tax schemes being advertised. Now, these are the ones that aren't approved by the revenue. People think they found a great idea to reduce tax and generate artificial losses. Any tax liability or any tax planning that is deemed to be abusive will continue to be challenged by HMRC. The tips that we're going to discuss today are all statutory reliefs, and they can all be used as the government intended. There's nothing dodgy about them. It's just measures to help a business improve cash flow and obviously for growth because you've got some more spare cash. So capital allowances, depreciation on fixed assets is charged to a company's profit and loss account, but it isn't allowable for tax. It's added back when you calculate your taxable profit. Instead, you get something called capital allowances, which will be given in place of depreciation at rates pre-prescribed by UK tax legislation. In the budget last year now, the Chancellor announced a new super deduction, which covered investment in new plant, machinery and equipment, which essentially is an enhanced form of capital allowances, which we'll look at on the next slide. And at the bottom there, annual investment allowance. That remains at £1 million for any expenditure on capital that doesn't qualify for the super deduction. So if you buy second-hand equipment, you still get the annual investment allowance. So the new super deduction. The super deduction was introduced by Rishi Sunak to keep the economy moving. With the corporation tax rates scheduled to increase to 25%, the government didn't want businesses to defer capital expenditure until next year. So they've effectively increased the allowances available on new equipment now to generate the extra corporation tax saving. This is also why the super deduction will end on 31st of March 23. So it's once the corporation tax savings aligned. The equipment must be new, it must be unused, and it must be purchased for the trade. I think there's an allowance for ex-demo vehicles, but everything else must be new. You can't buy a second-hand lathe or a second-hand laser cutter, etc. Integral features of a building, the saving is £95 per £1,000 of expenditure. So just going back to the top, what we're saying is if you're spending £1,000 on plant and machinery, your £1,000 is boosted by 30%, so it becomes £1,300, and then you get the 19%, which is £247. That is obviously the effective rate of 25%, which is where the corporation tax is moving to. Unlike the annual investment allowance, which is capped at £1 million, there's no cap on the amount of expenditure qualifying for super deduction. So you can spend whatever you like and bump it up to 30% extra allowance as long as it's new equipment. What I will say though is don't just go out and buy machinery for the sake of it. You'll get the same allowance next April. So if you don't need something, you're better to keep your cash sat in your bank, or just in case, you never know what's going to happen again. Company cars have always been taxed to the point that they're inefficient and not a great use of your personal tax band. They're very expensive on both companies and people personal tax. But now the government are trying to get everybody to move to electric cars. There's more incentive to do so. So newly registered fully electric cars qualify for 100% corporation tax relief. So what that means is if you spend £50,000 on an electric car, you'll reduce your corporation tax bill by £9,500, so 19%. Benefit in kind rates, whilst there used to be a significant proportion of a vehicle's list price, for electric cars, they're currently just 1% of the list price. And from the 5th of April this year, that's moving to 2%. So taking the example of, again, the £50,000 car, the 2% benefit in kind is £1,000. The personal tax on that will just be £200 or £400, depending on your tax rates. They are a very attractive way at reducing company tax without putting it onto a personal tax. And at the bottom there, where obviously fuel vehicle, petrol, diesel cars, there's a fuel benefit. For electric cars, you can charge them at work without any benefit. So your work can pay your electricity bill to charge your car. and then there's the small benefits. They are very attractive. Just going back, incidentally, not all electric cars are cheap little run around things. There's obviously the better, more expensive ones, the Teslas, etc. But Bentley have just announced that they're making an electric car in Crewe in 2025. So it might be worth waiting for that to really save some on your tax. Provisions. A company can make a specific provision against slow-moving, damaged and obsolete stock. You can't just make a general provision. So what that means is you can't just take your stock and say, right, we'll say that 10% of it is overvalued and we'll just reduce our stock by 10%. You can't do that. You need to look at it on a line-by-line basis. So you might have, let's say, Part A is valued correctly. Part B, you're not going to recover what you bought it for, so you can put your provision in for Part B. And obviously, reducing the value of your stock reduces your profit, reduces your tax. Same with bad debts. The debtors ledger should be reviewed in detail so that provisions can be made for all bad debts. Again, you can't just do a blanket provision, but where there is a reason to provide for a debt at the balance sheet date, provide for it. What you can't do though, which gets overlooked, is if at the balance sheet date you've no concerns about your customer and you think your debt's going to be repaid in full, if 4 months later, 5 months later, something happens and they go into liquidation, you can't, in theory, just provide for that debt. The reason for the bad debt has to exist at the balance sheet date. Bonus remuneration there. It might be possible to make provision for staff bonuses to be paid in the following year. So if there's a contractual liability to pay bonuses, or depending on the results of the financial year, you can accrue the bonus that will be paid. And provided it's gone through payroll within 9 months of the year end, your company can get tax relief in the year in which it was earned by the staff. But payments must be made within that 9-month period. Pension contributions. Employers receive tax relief on pension contributions, as it says there, capped at £40,000 per annum for 21-22. This is known as the annual allowance, and any contributions made over that will be taxed at your highest tax rate. So if you're a higher rate taxpayer, any contributions over 40, you get taxed at 40%. It is possible to contribute more into your pension with unused allowances from prior years though. So as long as you've been part of a pension scheme in the past, for every year where you haven't put in £40,000, you can top that up. So for example, this year, if you haven't put anything in for the last 3, you could put £160,000 into your pension and save 19% of £160,000, which I should be able to work out in my head. It's about £30,000. So it's a significant tax saving, and it's also a great way of planning for your future. Pensions though, the pension payment only gets tax relief once it's physically paid out of the bank account and into a pension fund. So what you can't do is get to the end of a year, realise you've made a load of money, decide that you're going to put it into a pension, accrue the pension and get the tax relief. You can't do that, which is why pre-year and planning is important. You need to have physically made the payment to get the tax relief. So the downside to everything we've covered so far is that it makes your balance sheet weaker. You're reducing your profit, you're reducing assets, you're reducing your net current assets. So your business looks weaker as a whole. Now, if you've still had a great year, that might not matter. But if it's just an average year, profits are modest, there is another way of reducing your tax bill, and that's the research and development claim. The research and development claims don't affect your accounts, they don't affect your profit, they don't affect anything on your balance sheet, they just reduce your corporation tax bill. So what classes as qualifying costs? So I've got a list here. We've got staff wages and related costs. So you might be employing people to look at a particular project for you that is going to advance technology. Their costs would be allowable, the employers and I would be allowable, their pension costs would be allowable. You might hire in subcontract labour to work on a project. That's an allowable qualifying cost for R&D. You'll obviously be using materials. You may use software costs. Depending on your market, you may use clinical volunteers, which is obviously topical given what's gone on over the last 2 years. But also there's light, heat and power. So you're obviously using energy to power your machines, to do your testing, to do your research. So all those sort of costs are allowable for research and development. Now, what you get is 130% of the qualifying costs. So if you spent £1,000 on labour doing an R&D project, your R&D claim will be £1,300 extra. So it's as though you've spent £2,300. So the tax relief there is 43.7%. Now, it's not easy to claim. You can't just say that you've done R&D. We advise putting a report together, which we can do, and your project needs to be something that isn't already out there, not already on the market, that you could easily find the answer to and just get the answer and not do your research. It's got to be a new project. So a few other things to consider. Financial presentation. So in the absence of recent financial information, credit reference agencies tend to take a prudent view and assign a high risk of failure to projects and companies. So where you're a new company or your latest accounts show a significant improvement in trading performance, you should aim to file your accounts as quickly as possible. By that, I mean as close to your year end as possible. So this is why your pre-year end planning is important, because you don't want to be waiting 9 months to actually have a really good year. If we'd have filed these 6 months ago, we could have had better credit agency references. We could have had better use of our cash, essentially. So there's ways to manage your credit reference, your credit rating as well. So where your cash flow allows, you could potentially pay your creditors early to improve your quick ratio. So you've got less debt on your balance sheet. But the quick ratio simply measures a company's capacity to pay its current liabilities without needing to sell stock and without obtaining additional financing. Alternatively, you might be best delaying paying your creditors, even if it's just by a day. This would allow you to show a strong cash balance at your balance sheet date, thus on your balance sheet, which is filed at company's house. And let's be honest, your creditors, if you're paying normally 30th, 31st of March, if you pay them the 1st of April, I don't think there'd be too much aggro coming through on email. I might be wrong, but your balance sheet position will be much stronger because you're showing a bigger cash balance at that date. Another reason for looking at financial presentation is you may have bank borrowings which may have covenants in place, and those covenants could be interest cover or debt equity cover, etc. So where you have those covenants, it's better to test them sooner rather than later. So if you're testing them before your year end, there may be things that you can do to improve the position at the balance sheet date, and therefore the date that your bank's going to check your covenants. So there's a few things you can do and a few things to think about. So it's not all about looking back, it's about looking forward too. So Making Tax Digitals have been around for a couple of years now. It's been delayed and it's been delayed, but it is coming in and it will be here. So you can see there, VAT, MTD for VAT is to be extended to all VAT registered businesses from April 22. So currently, if you are under the VAT turnover limit, you don't have to file your VAT returns digitally, you still do it manually. That's been scrapped from April, so you will need to find either software or another method of uploading your VAT return data. What is new is for individuals, the annual tax returns are set to be replaced by a new system in April 24, which seems ages off, but it's fast approaching. Individuals are going to be required to file quarterly updates followed by a final year-end declaration. So where you currently just do a tax return at the end of January, that's being scrapped. Quarterly updates must be submitted to HMRC, and they are for predefined HMRC quarters. So the 5th of July, 5th of October, 5th of January, and of course the 5th of April. Now, you can change them by election if you want to make it tie in with your firm's year end. So they aren't fixed, but they are quarterly. What this is going to mean is it's going to be far harder to backdate dividends. So currently, some of you may draw out money throughout the year, and then when you see your accountant, you'll do some dividend paperwork, put it in the right dates, put it in the right places, your personal tax position sorted, your overdrawn loan account sorted. That isn't going to be possible because you'll have already reported to HMRC that there were no dividends in quarter one, quarter two. So it is going to become much more important that you plan your dividends and your levels of income and how you're paying yourselves essentially. So that is the end of this quick taster to pre-year and planning and corporation tax mitigation. Our contact details are on screen. So we're Pierce. That's my email address, d.barker@pierce.co.uk. And if you do have any questions or anything you want to discuss, or you want to come in and see us, feel free to either drop us a line or drop us an email, and we'll come back to you as soon as we can. All right, well, thank you for joining. I hope you all found it informative, and I look forward to hearing from you soon. Take care.